What is a market maker? A market maker is an individual participant or member firm of an exchange that buys and sells securities for its own account. Market makers provide the market with liquidity and depth while profiting from the difference in the bid-ask spread. Brokerage houses are the most common types of market makers, providing purchase and sale solutions for investors. Market makers are compensated for the risk of holding assets because a security's value may decline between its purchase and sale to another buyer. While brokers compete against one another, specialists post bids and asks and ensure they are reported accurately. Understanding market makers. Many market makers are often brokerage houses that provide trading services for investors in an effort to keep financial markets liquid. A market maker can also be an individual trader, who is commonly known as a local. Due to the size of securities needed to facilitate the volume of purchases and sales, the vast majority of market makers work on behalf of large institutions. Market making facilitates a smoother flow of financial markets by making it easier for investors and traders to buy and sell. Without market making, there may be insufficient transactions and fewer investment activities. A market maker must commit to continuously quoting prices at which it will buy and sell securities. Market makers must also quote the volume in which they're willing to trade along with the frequency of time they will quote at the best bid and best offer prices. When markets become erratic or volatile, market makers must remain disciplined in order to continue facilitating smooth transactions. How market makers earn profits. Market makers are compensated for the risk of holding assets because they may see a decline in the value of a security after it has been purchased from a seller and before it's sold to a buyer. For example, when an investor searches for a stock using an online brokerage firm, it might observe a bid price of $100 and an ask price of $100.05. This means the broker purchases the stock for $100, then sells it to prospective buyers for $100.05. Through high-volume trading, a small spread can add up to large daily profits. Market makers versus specialists. Many exchanges use a system of market makers, each competing against one another to set the best bid or offer in order to win the business of orders coming in. The specialist posts these bids and asks for the entire market to see and ensure that they are reported in an accurate and timely manner. They also make sure that the best price is always maintained, that all marketable trades are executed, and that order is maintained on the floor. Example of market maker. Here's a hypothetical example to show how a market maker trades. Let's say there's a market maker in Apple stock. They may provide a quote of $10.00, $10.05, 100 by 500. This means that they make a bid for 100 shares for $10 and also offer 500 shares at $10.05. Other market participants may then buy from the market maker at $10.05 or sell to them at $10.